Hello, everyone. I'm Victor Kroeger, and welcome to the MNP Spring 2023 Agricultural Industry Webinar. High interest rates, inflation, and the war in the Ukraine continue to affect all of us. John will outline how all of these affect the Canadian and world agriculture industry. I am a Senior Vice President of MNP Ltd, the insolvency arm of MNP LLP. MNP LLP is one of Canada's largest professional services firms with offices right across the country. We have specialized client service groups that we call niches, each with dedicated employees working in them. This allows us to be able to provide our clients and the industry with knowledgeable practitioners. We have identified 16 specific business niches. Agriculture is our oldest and largest niche, dating back to 1958 when the firm was established. As the agriculture niche is so large, it is further broken down into sub-niches including food and manufacturing, intensive livestock, primary producers, Hutterites, cannabis, and farm income programs. MNP is also the only professional services firm with a farm management consulting group comprised of professional agrologists and consultants who come from extensive agriculture farming backgrounds and bring a high level of technical expertise, firsthand knowledge, and close relationships with the agriculture industry to give us a real understanding of the issues faced by today's agriculture industry. The FMC group supports all of our other service lines in any ag-related engagement, and in particular, in every agriculture insolvency or restructuring, where they provide us with expert advice as to a specific situation and, if necessary, to be hands-on in a formal engagement. John Loeppky from our Winnipeg office is part of our farm management consulting group and will again provide his insights into Canada's ag industry. John is a professional agrologist who has over 20 years experience providing services to the agriculture industry, starting as an ag vendor and then as a consultant to the industry. John grew up on a mixed grain and hog farm in southeastern Manitoba and still lends a hand on the farm as required. Our webinar has been pre-recorded to allow you to watch it on your time. At the end of the presentation, you will find contact information for both John and myself for any questions you may have. We will respond as quickly as we can with our answers. John, we look forward to your presentation.
Thanks so much, Vic. Yeah, here we are again in spring of 2023. Lots going on in agriculture in Canada and around the world. And so we're here to provide just a quick update for you. I think to start off, we'll just look at sort of what the agenda is for today. We're going to, as usual, start off looking at just some basic market fundamentals, and then kind of go through some of the major commodities that we're growing here and producing in Canada, and then end off. So I guess let's get right into it. So just starting, talking about some of the market fundamentals, we always want to start off with that, just recognizing, agriculture to a large extent is commodity production. And so with that comes usually supply and demand factors. And as we go through today, you'll see that sort of some of those are affecting different sectors to greater degree. And definitely, what typically we see is that supply is up and down. Demand is usually a little more constant, although obviously in certain areas we see that demand shifting. But typically that's what changes for agriculture is the supply side. Demand is usually pretty constant. So and a lot of times that affects prices for what farmers are getting for their commodities. And we'll talk a little bit about the US as well, just in regards to how some of those prices are set. We'll talk a bit about trade. It's obviously very important for Canada. lots of commodities that we're producing are getting sold outside of Canadian borders. So trade is always very important to supporting the ag industry here in Canada. So we'll touch on, maybe some factors that are affecting that today. And then supply management obviously is something a little bit unique that Canada has that a lot of other and areas in the world don't have. So really matching, that supply and demand a lot closer and not letting market forces interact as much. And so we'll see kind of what some of those factors are affecting our supply management industries. Even though supply and demand is a little more balanced, that doesn't mean there's not challenges in those industries as well. So, and just maybe a quick point, in the past, we've really kind of been driving towards globalization in agriculture and driving toward that really affects basically driving towards lowest cost of production. And as we've seen over the last couple of years through COVID, some of the supply chains getting disrupted, we're starting to see things trending a little bit more towards food security in our conversations, and that's maybe sometimes coming up to the top a little bit more as more important and more of a driver instead of necessarily the lowest cost of production. So, one thing we want to touch on is interest rates. Obviously, the charts here is showing, historical prime interest rates that Canadian farmers are experiencing, and you can see going back to before the financial crisis in 07, 08 there, we saw rates kind of in that 4% range, and then obviously spiking up. And then we had a long period of historically low interest rates. And I think what we've seen is there's lots of farms that have been built on those low interest rates. That was the operating environment that a lot of farms were experiencing. And to a certain extent, you adjust to that, and your interest payments are affected obviously by these interest rates. And obviously in more recent, we're seeing those interest rates really spike up. And so that's putting lots of pressure on farms in Canada. Anyone that was, highly leveraged to begin with, they're really struggling to manage with these higher interest rates, even though, if you go further back in time, 6-7%, those are what we would consider historical rates, right? So where they go from here is a bit uncertain, but I think in the short term, anyways, these are the interest rates that farmers in Canada are going to have to live with. I think there was a whole group that kind of locked some of their rates in, and maybe have been sheltered from these rising interest rates for the short term. But as the rates, continue and persist at these higher levels, more of those terms are going to come up for renewal, and they're going to be renewing into higher interest rates. So definitely something to watch out for is how interest rates are just affecting agriculture in general across Canada. We'll talk about land values a little bit, and your guess whether interest rates are affecting land values. We have our opinions, and we'll share those once we get to the crop sectors. But just wanted to point out though that lots of some of the strain that we're seeing is coming from rising interest rates, and I think part of it's just the velocity. Those interest rates change very quickly, and so then farmers didn't have a lot of time to adjust to those. So I think that was probably one of the biggest impacts we saw over the last year here was just the velocity that rates changed, and whether farmers had enough, cushion in their operations that they could absorb some of those higher interest rates. Also want to talk about exchange rates. As mentioned, a lot of industry in Canada on the ag side is for export. And so then we have to look at exchange rates with some of our larger trading partners just to get a better idea of what the farm gate price is that farmers might be getting paid when they export their products. So as you can see, the red is kind of the USD versus Canadian, and the green is the Euro versus Canadian. So I'll just say a lot of prices are set in the US and based on USD. So what their interest rate or what that exchange rate does definitely impacts the price that commodities are the price that farmers are experiencing back here in Canada. So yeah, just wanted to point out, it's kind of been bumping around, went up a little bit, came back down. So we're seeing some volatility there, but I think the bigger news isn't mainly more on the Canadian side, more on the US side. We're seeing or hearing lots of news these days about different countries maybe exchanging some of their sales outside of US or USD, which has kind of been the benchmark, and moving back more towards some of their domestic currencies. So I think that's causing the US to swing more than anything that is happening here in Canada. So, and looking at, some of those factors that are outside of our borders that are affecting us, as Victor mentioned, we have to talk about Ukraine. It's been over a year, I guess, since the invasion started. As you can see, it was Feb 24th there. And with that came some sanctions over the last year against Russia. And so we kind of list out some of the major ones there. Some of those import-export bans on all those various goods, and eventually all those likely shift back into agriculture at some point. And on the macroeconomic side, the EU and some of the Western countries, we're barring transactions, obviously, with some of those state-owned banks, and looking at energy is probably a big one that's affecting farmers for the most part. So as I think the biggest thing is we don't know how long or how extended this conflict is going to be, and what the impact is going to be if and when it does conclude. So I would say, though, I think what we're seeing is that everyone's gotten used to the conflict and markets are starting to take those into account. We're going to look a little bit again on the crop side because Ukraine is a big crop exporter. So that's a lot of where the disruption has been for some of those things. The other one, we wanted to talk about just in general that seems to be affecting the ag commodities as we're seeing, lots of year ends come in. This is a big one where we're seeing diesel and fuel costs just skyrocketing compared to last year. So you can kind of see on the chart there, based in Manitoba. So I use some Manitoba numbers here, but you can see that fuel prices really have skyrocketed in 22 and predicted to probably stay up there for 23. So that's an extra cost, I guess, that farms are adjusting to. And I can't think of any farms out there that aren't using fuel in some way, shape, or form on their operations. So definitely, along with interest rates, fuel is another big driver that we're seeing of rising costs for agriculture across Canada. Another one we probably want to talk about is Bill C-234. And so it hasn't passed yet. It's still going through the Senate, but if it goes through, good news for farmers, I guess, in that we're looking at removing the federal carbon tax from propane and natural gas. It's still on for diesel, but for propane and natural gas, they're looking at removing it for on-farm for necessary farm practices. So that's like heating your barns, drying your grain. If you're drying grain for a third party, you will get hit with a tax, but if you're drying grain for your own purposes, it's exempt. If you're heating a shop, I think that still falls under the carbon tax. So just want to be careful, I guess, of what it covers and what it doesn't, and it is kind of dependent on what you're using that propane and natural gas for. As mentioned, the U.S. is kind of our largest trading partner. And so we're starting to see this country of origin labeling maybe come back. It's, we've seen it before that it's been mandatory under COOL, and now they're looking at reintroducing it under a voluntary basis and it's going to be affecting potentially meat, poultry, eggs, and so remains to be seen what the actual impact is going to be. But anytime that we're differentiating between Canada and US, it just provides an opportunity to pay less for the Canadian product. So it's still really early in the process. We're not sure exactly. It's hard to speculate where it might go, but in general, anytime we've seen cool type of talk or legislation in the past, that usually has meant lower commodity prices for us here in Canada. So just something to be aware of. So moving into the poultry sector, I think probably the biggest thing affecting that sector right now is avian influenza. It's continuing. I think we saw it slide a little bit through the winter, but as those migratory birds kind of move back into Canada, I think we're going to see another uptick this summer. So it's affecting obviously not only Canada, the US as well, and so poultry, obviously one of the industries that's supply managed. So since we tightly can kind of restrict the supply side to match demand, anytime that there's sort of a tailing off in supply, it's a big issue because those two are so closely matched. So we know that it's harder and harder to obviously to get kind of your breeding stock, your chicks and that sort of thing. We're hearing, it's affecting the US just as much as Canada. So in the past, sometimes if it hit Canada, we could find some sources down in the US, but it's just getting tighter and tighter to find those. I think in general, the outlook is probably for moderate growth here going through 2023 for probably all the poultry sectors. And I think prices are improving with kind of that cost of production, but also lowering feed costs, hopefully, is what we're going to be seeing here. That's early indications anyways of kind of what we're looking at. So, and I think consumption has always been strong on the poultry side, and the expectation is that it's going to continue. The challenge is maybe more on the supply side, like I said, with avian influenza. So, and just a little bit of kind of what does that look like. Here's some numbers of kind of what we're seeing for infected premises, and 7.3 million birds has kind of been impacted as we go along, and it's not a large percentage if you want to look at it that way of the overall flock in Canada, but definitely since the last time we updated this, which was November, we're more than double of that. So and again, with the expectation that we're going to see a ramp up here in summer, definitely something to be aware of. Biosecurity obviously is top of mind for everyone in the industry. Moving on to dairy, we're kind of seeing mixed profitabilities, I think is probably the best way that we can put it. Some producers are struggling a bit, others are thriving. I think when we look at dairy, interest rates, like I talked about before, is probably something that's impacting their operations to a greater degree, just because dairy typically is more leveraged than some of our other industries. So they just can't cushion or have that flexibility to take on some of those bigger swings. So when we're seeing fuel prices go up, we're seeing interest rates go up. Those are big ones that are affecting the dairy, just because they typically don't have a lot of wiggle room. I think we've seen a whole bunch of dairies expand on those lower interest rates, and now they're having to service higher interest rates, which is starting to become troublesome for them. So there's some new trade compensation that's been announced since the last time that we did this, so I'll go into that next, and then maybe we'll look at some of those support prices increasing, and what some of those impacts have been. So just kind of to recap, the CUSMA compensation, I think we've talked about it before, but it's 1.2 billion over 6 years that's going directly to the dairy producers. We're seeing, you know, the old compensation for CETA and CTPPP ending. Those payments are coming to a close here in 2023, but the new payments under CUSMA are going to be starting here in 24. So we'll get another round of payments. It's just for a different trade deal that has been closed. So how the CUSMA payments are going to work, very similar. You know, it'll look very similar to those previous payments under CPTPP. And kind of just a rough example there, right? If you got about 80 milking cows, you're going to get about $106,000 is the estimate over 6 years. And as I've outlined there, it's kind of on a sliding scale, more weighted to the beginning and then sliding as you go further down. So, you know, anytime we're talking to guys on the dairy side, you know, we definitely want to reiterate that this compensation is to compensate you for loss of market, right? And I think what we're seeing is those farms that are struggling with profitability to begin with are taking this money and putting it into working capital, using it to pay the bills, to pay their loan payments, and not necessarily to invest in their farm and to expand and grow and become more efficient. And so ultimately, you know, the payments are going to come to an end, and so I think we got to be cognizant of that we can't be, you know, predicting out in the future that these payments are going to continue forever. So at some point, dairy farms are going to have to survive without these payments. So really important just to make note of that when you're looking at kind of future profitability and maybe how much debt you can take on. Definitely want to keep in mind that probably should be taking these payments out and normalizing your profitability without these in there. So, and just wanted to touch briefly on kind of milk prices. We're, you know, probably seeing about a 10-cent per liter increase, I'd say, year over year. And obviously that's largely coming from some of these increases that the Canadian Dairy Commission has issued over the last 12-ish months, if you want to call it that. So you can see there's a 8.5% increase in 22, 2.5% in September as a supplemental, just because inflation was running pretty quick. So just to keep up with inflationary pressures, they did a kind of a supplementary increase in September and then another 2.2 here in February. So yeah, we're expecting, you know, as inflation continues, we're probably see another increase coming here next February. But I always want to remind, you know, our dairy producers that it's always lagging, right? It's always coming after the inflationary pressures have already hit you. So you still have to be able to cash flow through that and make sure that we've got enough wiggle room or surplus there that we're not relying on those increases because they always come a bit too late. So next we're going to talk about crops. And crops obviously affect, you know, your cash cropping operations as well as anyone on the animal side that's maybe feeding these crops to livestock. So we'll spend a little bit extra time on crops just because it does impact a whole bunch of our different commodity groups. So kind of outlining there, we're going to look at Ukraine a little bit more intensely. We'll look at maybe what 2023 planting is going to look like for Canada. Touch on some farm equipment, and then always a fun one, we'll look at some farmland values. And like I said, we'll see if interest rates are maybe affecting some of those. So looking at Ukraine, you know, it's expected that they're going to export to a certain extent. These numbers obviously were before the conflict happened, and you can see that you know, even though they might not be the highest producing country, they definitely export a lot of their production. So when you take Ukraine out of the picture, that affects the global trade. And to a certain extent, it really is changing maybe who's buying what commodities and from which countries, and it's a big disruption. And I guess more recently now we're even seeing local countries around Ukraine kind of banning Ukrainian crops, because since they can't get out to the global market, they're flooding the local market. So countries like Poland are really trying to protect their own farmers, because the local Ukrainian surplus is driving the local price down as they're trying to push it out into these local countries. So, but yeah, just want to throw the chart up there just to give you kind of an idea of what they make up, percentage of global exports in some of those commodities like, sunflower oil and canola or rapeseed as it's listed here. They're a pretty high percentage of global exports, so definitely impact kind of the world price. So, lately we've been hearing about the fact that there's usually a 120-day renewal period between Russia and Ukraine where they let ships in to fill up with ag commodities and other exports and get out. And we're hearing that Russia is looking at maybe potentially shortening that up and going to 120 days, or sorry, pardon me, to 60 days. And we have a lot of grain companies that are really cautious about that. There are two reasons for that. Number one, 60 days is pretty short for them to get in and out. So they're worried about going in and their ships getting caught in the conflict and not being able to come out. And then those ships are kind of not productive, just sitting there. And the other reason is that they might get in, but due to maybe delays at port, they won't be able to actually load, and then they'd have to leave empty, which obviously adds just a lot of cost to their bottom line. So two things that are potentially causing some disruption. And last time we saw this happen, and Russia started maybe talking about tightening that window, what do you think happened? Wheat went limit up the next day. So definitely this conflict is impacting your crop prices as news of what may happen. Those speculators are definitely potentially driving those commodity prices in the short term anyways. So we're going to look at, maybe where planting intentions are. USDA always puts out some numbers in the springtime here. So this is what they have this year. We're looking at really big corn acres, 92 million acres. Soybeans is relatively the same, about 87.5 from last year. And wheat, again, really big wheat crop. They're looking at putting in close to 50 million acres. So you're seeing, their major crops going up. What's going down? Probably cotton and sorghum is the expectation that those acres are going to drop out. So definitely, commodity prices are still profitable. They're still high, relatively speaking, maybe coming off some of the highs of last year, but still relatively high. So farmers in the U.S. are definitely looking at planting kind of corner to corner as much as they can. With some of these weather events that we're having, some of these big winter storms rolling in through the Midwest and some of that, it's delaying planting. And anytime we're delaying planting, we're looking at maybe lower yields, which then means, lower supply on that supply side. And so when we look at Canada, just need to remember that Canada doesn't affect any world prices, even though we do export a lot. Probably canola is about the only one that we would have a chance at disrupting any sort of markets if we didn't produce any canola. We're just not that big from that side of things. So like I said previously, lots of our prices are all set in US and based on maybe what the US production looks like. So that being said, though, we're expecting, you know, close to 7% increase for soybeans. Maybe on a little bit lower yield is the expectation, but overall, you know, maybe 3.5% higher supply side on the soybeans. On canola, you know, a slight increase on the acreage side, which and also you know, probably flat production per acre. So, you know, about a 1.8% increase there. And on wheat, you know, excluding Durham, again, we're going to see more acres likely in wheat. Again, maybe slightly lower yield is the expectation, but put those two together, and we're expecting maybe a slight increase in overall wheat production here in Canada. So, you know, I think for a large part of the country, you know, planting conditions are looking favorable. Maybe a bit later for some of us, say in the West, but definitely I think the outlook is still pretty positive as far as planting conditions, and there's lots of optimism, I think, around growing conditions throughout the year. I think there's some good soil moisture, and so the outlook, I think, is pretty good on the production side. If we're looking at machinery purchases, you know, we always say it's kind of a little bit of an indication of the sentiment of farmers. When you got a little more jeans or money in your jeans, you go out and maybe replace some equipment. When times are tough, maybe you start repairing a bit more. So kind of the trend that we're seeing, you know, farm tractors on the two-wheel drive side is down about 25%. On the other side, the four-wheel drive tractors cost more money. Obviously, they're up 57%, and the big one is combine sales, right, up significantly over last year. So you know, probably some of that might be due just to supply issues. As manufacturers struggle to produce enough during COVID, there definitely was a bit of a supply shortage. But I think what we're seeing as a trend now is that manufacturers really aren't building a lot of surplus on speculation. It really is made to order to a large degree. You have to order it, and then, you know, 12 months, if you're lucky, out, you get your piece of equipment. So it's changed a little bit of the market from that standpoint, changed the used market, and inflation obviously is impacting the prices as we see those continuing to climb. So and just kind of the seasonality, if you want to look at it, of all the two-wheel, four-wheel, and the combine sales as we go. And yeah, interesting, obviously, just to see the big spike in October as everyone is in the field a bit more and likely buying their stuff just in time. So we'll take a quick look here at farmland prices. It's always interesting to throw this slide up. You know, those top lines are, as you can see, kind of your Iowa land price, and your cash receipts from corn, right? And so you can see there's a pretty good correlation there. When corn prices are up, land prices follow pretty quickly. You know, the bottom two lines there are for Manitoba. You know, Iowa is kind of known for corn. Manitoba, let's say, we grow a variety of different crops, obviously, so we don't have one crop that we would kind of peg it, but we kind of look at all the cash receipts for Manitoba and then look at Manitoba land price, and probably not as closely correlated with Iowa, but definitely you can see as cash receipts are going up, land prices continue to tick up. So, you know, I would say that interest rates to a certain extent modify land prices, but the biggest driver by far is probably what your cash crop prices are. And so, you know, given that we've got, you know, some historically high prices, decent production over the last couple of years, you know, I think the bank accounts for lots of farmers are are sitting pretty flush, and when that happens, they're a lot more willing to go out and spend an extra dollar for more land. So, great question is, interest rates have gone up. Does that mean that you're gonna pay the same or less as you did last year for the neighbor's piece of land? Likely not. Likely you're still looking to be pretty aggressive and outbid your neighbor. So, and if we kind of look at the trend of land prices, continues across Canada. As you can see, kind of 12.8% in 2022 in general across all the different provinces. So still farmers strong demand for land, and strong appetite, if you want to put it that way. And to a certain extent, I think it is that we're seeing some consolidation, and so we're seeing some of these smaller farms that are exiting the industry getting bought up by the larger ones, and when that happens, they're willing to pay a pretty significant jump year over year for those land or those parcels of land. So, and that's probably it for the crop side. If we look at hogs, we're probably seeing shrinking margins going forward this year. Last year was a pretty decent year for most of our hog producers. I think we'll take a look at a Manitoba example, but we're kind of seeing weaker prices, kind of coupled with some of those higher costs, are really going to start pressuring margins. We're also seeing some packer margin issues, and we'll get into that. I think there's lots of newer hog processors that were built in the US in the last, at least 10 years, but probably even shorter than that. And those processors were kind of built up to supply an export market and servicing, lots of Asian markets and that sort of thing. The US exports about 30% of their pork, and 70% is domestic consumption. So, I think we have a oversupply of processors, if we want to call it that. And that's because that export market is softening. And there's just not enough domestic demand in the US to replace it. So, really what we're seeing is processors maybe don't have a home for all of their product, and that's really causing some turmoil there. So, but if we kind of look at the production side, we run some modeling, and here's kind of what we've seen over the last 5 years, for a fair to finish operation. And this is just gross margin, mind you. Obviously, there's other costs that you have to add on to this, but definitely, the gross margin side has been good for lots of years for hog producers, and going into 23. The packers aren't hungry for pigs, so we're seeing definitely prices going down, but we're not seeing a lot on the production expense side softening, and probably your major expense there is going to be feed. So as the grain markets continue to kind of maybe be a bit lower than last year, they're still not dropping down far enough that we're going to see margins kind of maintain from what we've seen the last couple of years. So, if we're looking, January slaughter was about 7% higher than last year, and dress weights are declining, so guys are starting to ship lighter pigs, and what we're seeing is those cutout prices are averaging about $81, which is about 10.5% from last year. So, so that's a little bit why we're thinking that, it's going to be a bit of a tougher go for a lot of our hog producers here in Canada. So, and yeah, just touching again on those packers, two examples. We're seeing High Life looking to sell its underperforming assets. I know they've got that plant in Minneapolis, and closer to home here in Manitoba, they threw up a bunch of their farmland for sale. So definitely, trying to get rid of some of those underperforming assets. And then, yeah, probably some of the bigger news is the Olymel plant closure in Quebec. That means there's about 50,000 head per week that are looking for a new home to get processed. That's 1.25 million hogs, right? So pretty significant number. I know we're already seeing some of those pigs going to Manitoba slaughter plants and Alberta slaughter plants. So they're trucking pigs a long way to get slaughtered coming out of Quebec. So there's definitely disruption in the market, and there's an oversupply of what the processors are looking for right now. If we move on to the cattle side, it's strong outlook, I think, for the cow-calf side. We're largely based on pretty strong prices going forward. We've had, the inventories across the industry, that's Canada and the US, have, shrunk. And so that's buoying up some of those stronger prices. When we're looking at feedlot, obviously, same as the hog side, right? Those higher feed costs are continuing, maybe a little less than last year, but still not going away. So definitely we're seeing larger carcass weights. Steers are averaging probably 34 pounds higher than last time. Part of that's just that we're also better feed, better grass, as some of the parts of Western Canada had drought and we're coming out of that. But definitely the prices are definitely strong. We're seeing $34 higher than last February for fed steers, and that cash to cash basis continues to remain weak. It's $18 per hundredweight, which is $12 wider kind of than that 5-year average. And despite high prices and that wide basis, the U.S. demand has not been exciting really to start that 2023. So we'll kind of see where that plays out during the rest of the year. But as mentioned, there's been 2+ years of drought-like conditions in some of those major cattle producing areas in the U.S., and that's really caused a liquidation in the overall herd for North America. And we're seeing some rain this spring, so hopefully some of that grass is there this year. But unless we're going to see some significant moisture, I think we're going to continue to see that trend of that herd shrinking. And that extended lower numbers on feed has caused processing volume to kind of go down, and it's this big ripple effect, right? So when the packers start running inefficiently, their margins are at risk. So some of the winners in this short supply game is obviously on the farm side, right? Because that we're seeing some increase in prices for those live animals. So it's just interesting sometimes when you see that the retailer sometimes is the one that wins out of all of this when we go through some of these upheavals. So moving on to wineries, we're seeing potentially that supply of grapes for the Okanagan region could be pretty severely impacted. There was a cold snap a couple of days this winter that took out a bunch of production for them. So definitely not good news for a bunch of our Okanagan producers. I guess one good part is, though, the federal budget was amended to a certain extent. There was supposed to be that inflationary tax of 6.3% on their product, but they clawed that back, and now it's only 2%. So definitely good news for the retailers and for the whole industry that tax has kind of been going down. A little bit interesting, we're seeing demand weakening. In 2022, wine sales were, by volume, fell by 4%, which was kind of interesting to see. I think if we looked at sales in general, they were probably up just because of inflationary prices driving everything up. But interesting that the volume actually went down by close to 4%. So looking at cannabis, sales are kind of stabilizing out. But inventories, I think I mentioned last time, we're kind of overbuilt, so inventories are slowly starting to get eroded down. But we'll maybe touch on that on the next slide. And I think there's still that continued drive for that lower cost of production. But it certainly is getting hampered by that overproduction that we've seen in the industry. And that's driving layoffs, facility closures. I know Canopy Growth Corporation laid off about 800 workers. That was about 35% of their workforce, and they were closing their Smith Falls facility. So, I think it's obviously still hard for them to compete with some of the, we'll call it the illicit market, given that, they have a higher bar, right? So they gotta meet all sorts of regulations and safety protocols. There's tax on their product, whereas obviously that illicit market doesn't have some of those same costs and constraints on them. So that's kind of what we're hearing is there's still that struggle that's continuing on. So, and if we look at kind of a longer term a little bit, where inventories are at and where sales are at, you can see that, we have close to, looking at the Canadian industry here, we've got close to a year's worth of supply that's sitting in inventory right now. So, as I mentioned, it's really hard to remain profitable when you've got all that inventory sitting there that you got to chew through before you're going to go in and start making kind of your new product. So I think the industry got a little bit overbuilt, and that caused obviously the inventories to really ramp up more than sales. So it's going to take a while, I think, to correct that, and we'll probably see a little bit more pain in that industry before everything is right-sized based on what demand is in Canada. And looking at our food and beverage side, food inflation, I guess, is something everyone's been hearing about, everyone's been talking about, and definitely, as regular inflation has kind of come down, I think it was 4.3% roughly in March. Food inflation has kind of still remained relatively high compared to that, close to 9%. So definitely that's causing some sales side issues, right? As food costs are rising, consumers are making different choices, and the industry is trying to react to that. So, but yeah, obviously inflation in general is rising some of the food and beverage manufacturers' costs, and so maintaining some of those margins is becoming problematic, as consumers will only, the budgets are only so big, and they can only handle so much of that inflationary cost getting passed on to them. And like I mentioned, they start making different choices based on that. So some good news though, there was some changes to the temporary foreign worker program in the last budget. And so that's going to make it easier and faster for the industry to access labor. And as I've mentioned in other presentations, that was kind of one of their big issues recently was just accessing labor was really tough for them, and obviously adding a lot to cost for this sector. So, and just the last slide here, just showing kind of where food inflation has been over the last couple of years, and you definitely can see that we're maybe getting back more into what I'd call maybe a more normal range, but definitely we saw some big increases on the food inflation side. So not quite back down to the level of we'll call it normal inflation for the rest of the basket that they use to put together the consumer pricing index inflation side, but definitely a struggle for the industry as consumers can only bear so much. They only have a set amount of budget for the most part, and so we're starting to see some of the impacts of that as we go through this. And that's probably it for my presentation today. Thanks so much for joining me, and I'll turn it back over to Vic.
Thank you, John. It's amazing the changes that happen to the ag industry in a 6-month period. And hopefully this has been of great use to all our listeners. And we'd like to thank everyone for participating in this webinar and would encourage you to contact John or any of our other FMC practitioners directly with any specific agriculture questions you may have. Any insolvency related questions should be directed to me or any of our Cross Canada Insolvency team. The appendix to today's presentation includes further information about MNP and our Farm Management Consulting Group. This webinar link has been sent to all of you as you have requested to be added to our Ag webinar distribution list, and it will be posted to our mnpdebt.ca website. I believe the webinar link will include a request for you to confirm that you want to stay on the distribution list. And so please look at that and continue to participate. Please feel free to forward the link to your colleagues and to encourage them to contact me directly should they wish to be added to the distribution list. We look forward to your participation at our fall 2023 webinar, and we also look forward to hearing from you with any questions or comments you may have, and we look forward to assisting you in the near future. Enjoy your summer, and thank you for listening.